After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the Reserve Bank MPC decided by a majority of 5-1 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is the SDF, rate remains at 6.25%, and the marginal standing facility, that is the MSF rate, remains at MSF rate and the bank rate, they remain at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth.
Hello and welcome to Business Today Television. That was RBI Governor Shaktikanta Das telling us why the Reserve Bank of India, the Monetary Policy Committee, has kept the repo rate unchanged and the prospects for growth and inflation going forward. And this was the first policy meeting of the current financial year, and joining me to decode and dissect the implications of what the MPC did and did not do are two of India's foremost macroeconomists, Madan Sabnavis, the chief economist at the Bank of Baroda, and our favorite perennial guest, Saugata Bhattacharya, senior economist who has covered God knows how many monetary policy committee meetings. I'll come to both of you, starting with you, Madan, in terms of the key takeaway and the highlights of what you think was most significant in today's announcement.
In fact, there were two significant announcements. See, one is that the RBI has reposed faith in the growth which is taking place in the economy. So normally we say that central banks have this kind of trade-off between growth and inflation. But I think what they made it very clear is that since India's growth has been robust in the last 3 years, expected to continue on the same path in fiscal 25, it means growth is not really a concern. The second thing which the RBI has reiterated is that they are still targeting 4% inflation. So it's not that because inflation has come down from 5.7% to 5.1%, the RBI is happy about it, or maybe because it's going down to 4.9%, the RBI is satisfied with it. I think they are targeting 4% that is being held sacrosanct, and accordingly, we see these policies are going to meander somewhere around this particular target, taking a call depending upon what the actual inflation number is and what the trajectory for the subsequent months are likely to be.
Saugata, that same question to you. Your most important points that you have taken away from this announcement.
Well, obviously, status quo. Everybody expected that. They wouldn't mention anything about liquidity, but I'll come to that later. So what struck me was this unwavering focus on inflation. You will have noticed again and again, every 2 minutes in governor's statement, there was something. A robust economy allows a focus on inflation, stance is actively disinflationary to anchor inflation expectations, last mile challenging. Last mile, by the way, has become a favorite of global central banks, all central banks across the world. RBI has policy space to unwaveringly focus on price stability. And finally, the point on incomplete transmission. The transmission is still ongoing. MCLR transmission has not happened completely. So to my mind, that seems to suggest that liquidity on the margin will be held slightly negative rather than slightly surplus, as we were initially expecting. That's not going to happen. Finally, very briefly, I think that major analogy of the elephant in the room, now proceeding towards the forest, but we'll have to make sure that that elephant stays in the forest, doesn't come back, seems to suggest that we are not going to see a rate cut any time. Probably not even before December of this year, if at all, if that is the case at all. And that goes in hand with the inflation forecast that they have mentioned. And as Madan mentioned, that they hold 4% absolutely sacrosanct, and till inflation actually durably reaches the 4%, they are not going to move on easing policy.
Madan, how long will they hold 4% sacrosanct?
No, I think 4% is the mandate of the MPC committee. So I don't think there can be any wavering around that. But the whole question is that how do you look at this 4%? if the inflation number is moving closer towards the 4% mark, is that something which will give comfort to the RBI? Or is the RBI going to be absolutely resolute in saying that unless we touch 4% or go below that, we're not going to lower the rates? I mean, that's another question which comes up. But in the past, we have seen that when the inflation number is in this region of around 4.5%, on a continuous basis. That's what I think the terminology used is durable basis. I think that's the point of time when we actually see rate cuts taking place. So currently, if I look at the situation, if you look at the forecast which the RBI has given out, Q1 4.9%, definitely no chance of a cut out there. Q2 3.8%, yes, possibly that's a time for them to consider if the conditions are congenial in the sense that we have a good monsoon, good spread of monsoon at that point of time in August. Maybe the RBI could take some call on it. But then as what Saugata was saying is that, look, after 3.8, we're going back to 4.6, 4.7. Is that going to be acceptable or not? So I think it's going to be a judgment call. We have six members sitting on the committee, and what a majority decide will finally prevail. But otherwise, if we're going to say 4% is sacrosanct, I'm not going to do anything until 4%, it's going to be very difficult for the RBI to lower the rates. But I would tend to think there'll be a bit of flexibility. If we're below 5% on a durable basis, there could be a good chance of rate cuts, maybe from August onwards.
Okay, Saugata says not before the end of the calendar year. Madan says August. But let me, Saugata, ask you about a statement which is obviously linked to the other side of the trilemma, which is growth. And the RBI, in the briefing afterwards, said that potential growth appears to have gone up. Now, what does this imply? Because the numbers for growth estimates for the current financial year have also been projected at 7%. So potential growth appears to have gone up. What is the RBI really saying here?
So the obvious takeaway from the potential growth statement, and that they have been saying even before, even in the past, they have mentioned that potential growth. Nobody knows the number, might be 7.5, might be 8%. So that would mean that if growth is at 7%, that is probably a non-inflationary growth trajectory. So that is, in other words, the total amount of capacity that exists in the system. So the economy can grow at 7% without the economy overheating. So that would mean that core inflation, manufactured inflation, or core services inflation, even if the economy grows at 7.5%, 7%, are unlikely to flare up. So if only you are operating at the potential growth, is there a risk of the economy overheating and thereby requiring more monetary policy tightening, etc.? So that statement seems to suggest that there will be no tightening on the horizon, since we are still growing below the potential growth rate. And second, if, as Madan says, that if there is a durable decline in the inflation trajectory, that might open up space for rate cuts and monetary policy easing.
Madan, what are the risks to the RBI's statement on potential growth? Both from uncertainties, the monsoon, and any other external black swan events, and also if you could add the other comment which was made, which is that rural consumption has recovered and is gaining. So how do you square this off?
See, in fact, Siddharth, I would tend to think that the major risk which we have is of rural consumption not really recovering. I think there were two statements made. That is that one is that rural consumption is on the verge of recovery, and private investment is also taking off in a more broad-based manner. Now, I think that rural consumption story is something which we have to hold the reins, because A, we don't know about the monsoon, and second, something which I don't think found mention in the statement was anything to do with the heat wave which we're seeing right now. Because the kind of heat wave which we have, the temperatures going high, I think the IMD said it's going to be one of the highest temperatures in this next coming few months before the monsoon arrives, could actually mean that there's a potential threat for food inflation, because while the major crops may not be grown or harvested, wheat, of course, can get affected in case at the time of harvest your temperatures are very high. But I think horticulture is one particular area, because we have seen vegetable inflation being very high in the past. And in case the heat wave does persist and turn out to be what the IMD is saying, I think there is a great threat to inflation actually going up in the first quarter of the year beyond the 4.9% which the RBI has estimated. So I think that is the major threat, and that is what is going to lead to probably affect even rural consumption, which we have just taken for granted that a good monsoon means rural consumption It's the case of distribution across regions, across crops. I think those are the other micro factors which have to be looked at. But at this particular moment, I would say this entire business of rural consumption could be a risk on account of the heat wave right now and the uncertainty about the spread of monsoon. Maybe today we know that it's going to be a normal monsoon, but as I mentioned, the spread is going to be more important.
Okay. Saugata, since we spoke about the RBI wanting the inflation elephant back in the forest, what is the risk to that from what is going to possibly happen and is already panning out as far as crude oil prices are concerned?
So obviously, I mean, there are multiple risks. Crude oil, of course, is something which is very immediate in our sensing. Crude oil immediately does not translate into higher CPI inflation because the transport fuel component doesn't move together with the crude oil prices in India. But there are many other components. I mean, jet fuel, lubricants, other fuels, etc., which do move with the crude oil prices. So that's something. Crude oil immediately impacts the WPI inflation. That's one. And then obviously via other transport costs, etc., filters into CPI inflation. So because, I mean, India is such a large importer of crude, that's something which is very salient in our minds. But together with that, remember, there are other risks to inflation because China is now exporting a significant amount into the rest of the world. And China's exports, if it actually increases, and that's what the government is trying to get done through various dumping measures, etc., that will have an immediate impact on global commodities prices, particularly metals, steel, aluminum, copper, nickel, etc. So all of that. So that is also another risk that is there in the horizon. And then, of course, food remains an omnipresent risk because remember, this winter, normally there's a seasonal effect in the winters that fruits and vegetables prices fall during the winters. They did fell during the winter months, but not as much as they should have fallen. And thereby the prices remain high. And as Madan said, with the heat wave predictions now, that they are likely to be adversely affected. The good point in all of this is that global meteorological bodies seem to suggest that the El Nino conditions till the end of March will transition into a neutral phase over the months of April to June, and thereby July to September they will move to La Nina conditions, which is good for monsoons. In fact, they have actually predicted a higher than normal monsoon rains this monsoon season. So that's one positive development in this. Hopefully that will pan out, but that remains a risk.
Let's take a quick look at the markets because market sentiment was perhaps a little tepid after the policy announcement, and clearly I think there is some amount of uncertainty because the repo rate has remained unchanged for 14 months. There you can see the Nifty right up on the screen for you. Let's also bring up other counters, but clearly the Reserve Bank of India's announcement that a rate cut is now in some ways, at least from the point of view of the market, linked to the inflation rate reaching 4%, that seems to have created some amount of uncertainty because while broadly speaking there is some amount of deflationary trend, but as crude oil prices, food prices, they are also adding to the uncertainty as both of our guests have just mentioned. Madan, is the market reaction par for the course, or do you think they should have looked beyond what the RBI has said on inflation?
No, I think the market reaction was more or less expected, and I think none of us really expected RBI to do anything. In fact, with even the growth numbers, inflation numbers virtually remaining unchanged, so there was actually no surprise element at all. So there was no reason for the market to react in any different way. And looking just at a 10-year bond, I think we've seen even that yield hasn't really changed. And it seems to be driven more by what happens to the US Treasuries rather than the state of liquidity in the system. Because today we have surplus liquidity, yet we haven't seen a 10-year bond yield actually come down. It has gone up because ever since the US Treasuries have gone up. So I think the markets would continue probably from tomorrow onwards, or rather from next week onwards, things will be back to business as usual. And this would have been behind it.
One of the other sideline events in the policy, Saugata, was in our words, the point about RBI being the Forex king and all-time high of nearly $646 billion as of the 29th of March. And I'm noticing a lot of chatter about that because sometimes these numbers lead to a surge in sentiment, nationalistic sentiment in some ways. Any comments you might want to offer for our viewers on what does this really mean, this highest level of foreign exchange reserves?
So as RBI governor has always mentioned, so this serves as an umbrella during bad times when there are debt stop events happening, risk off events happening, capital goes out. So the RBI probably will take it up to 700 billion if they can. And particularly with the bond inflows now expected from June onwards, they will keep on buying. Because one, they're not going to allow too significant an appreciation in the rupee versus the dollar. That's one. But remember that a lot of the movement in the Forex reserves, not in the near past, not in the last 2 or 3 weeks, but a lot of the movement that has happened is due to valuation changes. Because as the dollar strengthens, so the other currencies begin to move up, move down. So the dollar weakening against the euro, the pound, etc., that has taken up the level of the foreign exchange to a certain extent. So there is a component of valuation changes which is pushing up the total exchange. But I mean, there have been inflows as well. The second part relating to your previous question was that I think this is a deliberate move, this focus on inflation, that we are not going to 4% is sacrosanct, etc., because financial conditions, as they are called in the markets, had eased very significantly over the last 3 or 4 months. Equity markets globally, equity markets are going through the roof, as in India. Bond yields had dropped, the 10-year benchmark had dropped. Credit growth still remains very strong, etc. So, I mean, what is known as financial conditions, which is inimical to the objective of getting inflation down to the target, had eased considerably. So I wouldn't be surprised if this is a deliberate move to bring down the sort of frothy levels in equity markets as a deliberate measure to bring back. Not that it will work to any significant extent, but this might have been a deliberate tactic or measure to try to reduce the amount of froth in equity markets.
Interesting choice of words, including the word froth, Saugata, that you use, because the market regulator used that word recently, and that led to a nervous reaction in certain stocks. And in the context of the RBI, Madan, let's again step back and ignore the red that we just saw on the screen. The monsoon always, there is a bit of uncertainty happens year on year, but broadly speaking, the expectations of a normal monsoon. Inflation moderating, some trouble spots always remain on the horizon, but there is sustained momentum as far as manufacturing is concerned. Just yesterday we saw some more numbers around services. There is a lot of enthusiasm. There is a very strong sense of continuing policy certainty with the elections on top of us. Crude oil may be going up, but as we have managed pump prices for almost 1.5 years, we can expect a similar strategy of purchasing cheaper crude to offset any spikes to continue. So given all of that macroeconomic framework, don't you think it is time for market participants to also ignore some of the chatter around trade disruption, what happened in Taiwan, some fears around semiconductor shortages, because I think that's par for the course really from an overall growth perspective, Madan?
See, we have seen in the past also that when we had the disruptions of these semiconductors, I think Taiwan was the country which was involved. We saw the entire automobile industry getting into trouble. But I think we have come a long way since then. And I think with more diversification in terms of sourcing of our products, we have seen that even things like wars have not really had serious disruptions on the world economy, including India. So I think when we are talking in terms of these kind of the disasters which we saw in Taiwan, it's less likely to have a perceptible impact in terms of the growth pattern of countries. Though I think this will definitely be something with certain sectors, specifically we're talking of the automobile sector, or if we're also looking at the electronic sector, there could be definitely concerns out here, but it would be more sector specific rather than at a national level. So I think that's what we have seen, which has been happening ever since these different kind of crises which we have had, starting with COVID, is about this product diversification, sourcing diversification, which has taken place, which has, to a certain extent, helped to buffer us against these kind of crises which take place in any part of the geography.
Absolutely. And viewers, in fact, beyond the main part of the policy, as has been happening in recent policy announcements, some of the other announcements and details that are put out in the press statement are of great interest. For example, it has also been declared today by the RBI that they will release Fintech self-regulatory body norms by the end of this month. So some of these nuggets of information are significant. The RBI has also started a use case of the e-rupee for farmers, and obviously that's a next step to the introduction of the e-rupee. The point that was made about the building up of the gold reserves, and also a point about significant movement towards term deposits, and CASA is down. As we wrap up the show, Saugata, closing comments from you in terms of any other significant announcements that you saw, including, for example, continuing to build on the UPI story to allow cash deposits at ATM through the UPI, wallet payments via third-party UPI apps, CBDC through non-bank payment systems, and retail participation in government securities. So some of these smaller announcements also have some amounts of interest, Saugata.
No, you're absolutely right. I mean, all of this is building up. Remember, to my mind, what is striking was Prime Minister Narendra Modi's speech at the RBI 90th thing, that RBI should get ready for a whole dhamaka of work coming their way. To my mind, the first thing that I read from that is a renewed push for rupees convertibility. So rupee as an international reserve currency. That's the first one thing that strikes my mind. So, I mean, to get to that, I mean, you need a very solid payments, digital public infrastructure, payments infrastructure, etc. And the government is really trying to get a sovereign ratings upgrade with the fiscal discipline, etc. So all of this is part of this concerted whole to make India's financial sector a real big player in the global financial markets.
Okay. Madan, final word on the show to you. So, if you were drawing up part of or the entire 100-day agenda, what would be your priority in the context of broader monetary policy, banking system points that we are discussing?
No, I think from the point of view of the banking system, I think it's shown resilience, it's shown the buoyancy and adaptability to the situation. But so I think for the government coming to power, I think the main job will be to try and revive industry, because I think that is something which has been lagging. We've had the PLI, which hasn't quite worked the way which we thought it would. Because I think these issues of industrial growth, that is manufacturing growth, covering even the SMEs, and employment, I think these are the major issues which we have. And I think the next 5 years, I think it cannot, of course, be done in 100 days' time. But I think the agenda for the next five years will be definitely to try and make sure they're able to create jobs, which also goes backwards to making sure that you have the right skill sets, education. So I think the focus will change more towards this particular social side. The rest of it, I think, is on more or less on autopilot.
Absolutely, and that's an important point, viewers, because even as overall FDI inflows are down, there is a fresh challenge that India faces. While we have opened up so many sectors and we have schemes, including that, some of which would be of great interest to foreign investors, there is a challenge in terms of what is happening in the United States, for example. The US has now become a very big destination for investment, because it is going on an investment overdrive, for example, in manufacturing of semiconductors. And we have seen several major announcements in that space vis-a-vis China. So the fight for foreign inflows will continue to remain and perhaps increase in the months ahead, given what is happening in the United States of America, and that also has in the long term macro consequences for India and the currency as well. Madan Sabnavis, Saugata, Bhattacharya, thank you very much for your time with us today as we tried to decode the first MPC policy decisions of the current fiscal. If you've been, thank you very much for watching. We'll be back with more. Do stay tuned into Business Today Television. I'll see you again. Until then, goodbye.
The domestic